All right, so let's break down the latest earnings report from a true giant of the consumer world, Procter& Gamble. The company that makes pretty much everything in your house, like Tide, Pampers, and Gillette. But behind those headline numbers, there's a really fascinating story of some struggles and some real strengths. So let's dig in and figure out what P&G's latest report is really telling us. So right off the bat, we're looking at a pretty interesting contradiction. On one hand, P&G's profits, their earnings per share, actually came in higher than Wall Street was expecting. That's a beat, that's good. But on the other hand, their total sales, their revenue, fell short. So what does that actually mean? It means they were more profitable than people thought they'd be, but they sold less stuff than everyone expected. So why? And yeah, that revenue miss wasn't just a rounding error either. We're talking over $152 million short of expectations. This immediately makes you wonder, right? What is causing this disconnect between their profits and their sales? To get to the bottom of this, we've got to look a little deeper into where P&G is making its money and where it isn't. And the answer, really, is a tale of two very different stories playing out in two different parts of the world. P&G's overall performance is a story about struggles at home and some surprising success abroad. So let's start with the tricky part. The biggest thing dragging P&G's results down came from its largest, most important market, right here in the United States. In the US, their organic sales actually dropped by 2%. And look, when your home turf, your biggest market, is shrinking, that's a huge problem for the whole company. And if we dig just a little deeper, the picture becomes crystal clear. Check this out. The family care segment, the one with massive brands like Charmin toilet paper and Bounty paper towels, its sales plummeted by a staggering 10%. Just think about that. That one category had a massive impact on the overall numbers in the US. So you have to ask, why such a huge drop? Well, P&G's chief financial officer, Andre Schulten, basically said it was because of pantry loading. In plain English, we all just stocked up too much. People bought so much toilet paper and paper towels in the last few quarters that our pantries were full, which led to a major drop in sales this time around. Okay, but while the US was dealing with overstuffed pantries, the story was completely different overseas. And this is where we see the other side of the coin. P&G's international business actually delivered some very welcome good news, and it paints a much, much brighter picture. The contrast here is just stark. Look at this. Latin America was on fire with 8% growth, key markets in Europe grew by a solid 6%, and even in a tough environment, Greater China was up 3%. This strong international performance is really what saved the day and kept P&G's overall results from looking a whole lot worse. So what do you do when you're faced with a weak US market and a world that's just changing incredibly fast? Well, P&G isn't just sitting around. Management has laid out this ambitious new strategy to tackle these challenges head-on, and they're calling it a reinvention. And they are being very, very clear. This isn't just a small adjustment or a little pivot. They are calling it a reinvention. And that word signals a fundamental multi-year shift in how they do business. They're aiming to create what they call the consumer packaged goods company of the future. And here are the words straight from the new CEO, Shailesh Jejurikar. He's recognizing all the disruptions we're seeing, fragmented media, new ways of shopping, you name it. And the goal here, as he says, isn't just to keep up with all that change, but to leap ahead of it. So what does this whole reinvention thing actually look like? Well, it's built on three main pillars. First, using integrated data and AI to understand shoppers better than ever before. Second, building a much smarter, more automated supply chain 3.0, to avoid those pantry loading problems. And third, just radically speeding up innovation across the board. Okay, so to make this less abstract, check out this fascinating example from China. P&G launched a super premium diaper line there that contains, get this, real silk ingredients. By tapping into a deep cultural appreciation for silk, they created this luxury product that's driven double-digit growth. It's a perfect example of what they're talking about, using deep consumer insight to innovate fast. So, with a challenging quarter now in the rearview mirror and this bold reinvention plan ahead of them, what's the outlook? What's the game plan for the rest of the year? Let's take a look at what the company is telling its investors. Well, despite that sales miss and the weakness in the US, management is sending a really clear signal of confidence. They are holding firm on their financial forecast for the entire year. They're basically telling Wall Street, hey, that soft quarter was a temporary blip, not the new normal. And they're backing up that confidence with a whole lot of cash. P&G plans to return roughly $15 billion to its shareholders this year through dividends and buybacks. I mean, come on. A company simply does not make a commitment that big unless it's feeling absolutely rock solid about its future. And that, of course, brings us to the final, crucial question. P&G is this massive, historic company that's betting big it can use AI, data, and super fast innovation to totally transform itself. But will this high-tech reinvention actually be enough to connect with the changing habits of consumers all over the world? Well, that is the multi-billion-dollar question P&G is going to have to answer.